Hi, everyone. This is Jason Briack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I'm happy I can get him on every couple months to give us an update on his views of the markets. I really enjoy his views of the markets. As many of you listeners know, I've been listening to the McAlvany Weekly Commentary pretty much every single week now for years. It's one of my favorite pieces of content and way that I learn. And we're happy to have David McAlvany back on for another podcast. So thank you for joining us again, David McAlvany.
Grateful to you. Thanks for having me back.
Now, David, the ECB has set negative interest rates. Is this the Keynesian endgame, and is it finally approaching for Keynesian economics?
You know, what's interesting is that they continue to sort of outplay us. We're almost out of bullets here in the U.S., and the ECB has done a remarkable job talking to the market off a cliff and then implementing incremental changes. The most recent one, certainly speaks to me that we're not past the worst, but they still have other options up their sleeve. If they want to, they can still purchase assets. And over the last 2 years, they've reduced the ECB balance sheet in such a way that they've got some latitude there. So, whereas the Fed with a $4 trillion plus balance sheet is sort of at the outer edge of what else can be done, the ECB can still get creative. Negative interest rates are one expression of that, never been done before in central banking history. Now, I say that we've been running negative real interest rates for several years. That is, the interest rate that we're offering plus the inflation rate factored in. Your real rate of return is negative, although the stated rate is not negative. So we're flirting with the same kinds of policies, just on an unofficial basis, and they're venturing into the unknown, with this most recent announcement. So what does it say? I think we've got another round of consolidation in European banks over the next 12 to 24 months. They're moving with Basel III into a very awkward position, with banks loading up on government debt, treating it as a risk-free asset. Is it risk-free? I don't know. You tell me. Is there a difference in credit quality between the Germans and the Spanish? Not to pick on any particular country, but in terms of the fiscal picture in each of those countries, I think you're looking at a very, very different backdrop, and the debt markets really aren't signaling such at this point.
I think government bonds, pretty much all government bonds, are like what Jim Grant says, they're return-free risk. And if you read Martin Armstrong, David, is actually predicting that the U.S., Janet Yellen maybe, will eventually try negative interest rates too. Do you think that's likely, or do you think Martin Armstrong is going out too far on his predictions?
No, I think that's very possible. Something has to start stimulating lending, and if they can create some sort of a penalty for that sort of cash balance or excess reserves, that may free up the dollars that are sitting dormant at the Fed and in the banking system and get them into the economy. So far the recovery has been one in asset classes, not in the general economy. So we've seen growth in the stock market, we've seen growth in real estate. But if you ask Joe and Susie Lunchbox out there, what they would tell you is that they still have concerns about getting a pink slip. They also are very concerned that, frankly, the economy is not really gaining traction. So I think on an anecdotal basis, and certainly with the most recent GDP figures, we have some measure of no real return to health in the U.S. economy. So will they create a penalty rate for excess deposits? That is a Keynesian endgame, as you described it. They want to destroy the rentier class. If you have assets, they don't want you to save them. They don't want you to be collecting income from them. They want them spent, and they want them churning through the economy, the Keynesian dream.
Exactly, and I read Henry Hazlitt's Failure of the New Economics, which goes line by line through Keynes's general theory, and it seems that Wall Street and the academics, the Keynesian academics, they're apologists for Keynes. They said, Keynes would have never advocated quantitative easing or 0% interest rates or anything like that, but that's not what Keynes said in the general theory. Keynes seemed to insinuate that every single time there was a boom and then a bust, the way to stop the bust was to come up with schemes for more booms and to lower, interest rates to zero bound, to keep lowering interest rates as much as possible, and to force the savers, the evil hoarders, to get rid of their money, because he blamed them for destroying the economy because hoarding was bad and, it hurt wages and prices and all these other things.
Yeah, it seems to me that the one difference between our central bankers, who certainly are playing from a Keynesian playbook, and Keynes himself. Maybe there's a difference between Calvin and Calvinists. Well, in this case, there's probably a difference between Keynes and Keynesians, and it is that our central banks today have not sort of leaned into the wind as they were supposed to. As we saw growth in the economy, they should have tempered themselves and not sort of added fuel to the fire. And that's where they adopting pro-cyclical policies have exaggerated the upside and then try to defend the downside. Keynes would have said, absolutely, defend the downside. You need central planning and central planners to step in and do that. But I don't know that he would have been as aggressive in sort of adding monetary fuel to the fire on the way up.
Okay, that's a fair point, because he definitely says on the way down, he says, keep pumping liquidity into the system, which sounds to me like quantitative easing programs. And he was like, the banks and central banks could replace the liquidity, change the liquidity preferences of the savers, and then also, pump more liquidity into the system, because he thought that was the key to, growing things, was just more liquidity. Now, in terms, switching gears here, let's talk about Belgium. I've interviewed Mark Faber. I've interviewed other experts about this, and no one seems to really know what's going on there. How is Belgium buying so many U.S. Treasuries? And if they are buying that many U.S. Treasuries, is there really a taper at all then?
We've seen a number of different instances where mass purchases of treasuries have occurred, and the place is less important than the people behind the scenes, almost like the Wizard of Oz. What is happening behind the scenes? We've seen major treasury purchases in the Caribbean. We've seen major treasury purchases in Britain. We've seen major treasury purchases in Belgium. And in each instance, it is a cover, if you will, for someone who is taking a position there. Is it the U.S. Treasury? Is it the Chinese? Is it the, fill in the blanks? There's a number of different alternatives. Perhaps it's the ECB. The last thing that people need in this environment is for full disclosure to occur. I mean, it's one thing to talk about transparency, and that's certainly what's popular. But when central banks are operating in a way to manipulate markets, the last thing they want is for people to know sort of the mechanisms that they're employing. Why? Because you can front run that. Because they know that market participants, if they knew who, what, to what degree, when, they would be played. They would be played against, and there would be arbitrage opportunities emerge. So my sense is that you've got central bank cooperation. The Treasury makes a few phone calls and says, here's the deal. We're either going to have undersubscription on this particular issue of Treasuries or what have you, and we'd participate. We would expect some participation here. So that is, I think, a continued trend. Last year and the year before, those purchases were centered elsewhere, again, the Caribbean and Britain. And obviously it wasn't the British national government, wasn't the Bank of England, and the Caribbean Central Bank certainly was not loading up on treasuries. You're talking about hedge funds and sovereign wealth funds as a proxy for central banks and specific country interests, which were buying in earnest, I would believe, at the request of the Treasury.
A good point there about the cooperation between central banks. I think it was 2 years ago in November of 2012, I think after QE2 had come out, and it looked like in the overnight markets, Europe was on the brink, and Japan had Fukushima, I think, and then all of a sudden you had this overnight meeting before the markets opened in New York, and all these central bankers were on the phone, and instead of the markets crashing, nothing happened. So I think that's going, and if I could add to your point there, I have a local money manager friend here in the D.C. metro area, and he just went to a very large IMF conference here in D.C., and there was Keynesian central bankers, there was technocrats from all over the world, and they're talking about the next system. So they're talking about, even Paul Volcker, I think, came out in the last couple weeks and said, we need a new Bretton Woods, the system's done. So these guys are willing to work together. Ben Bernanke had said that, if everyone prints quantitative easing at the same time, it's not really a currency war or competitive devaluation if everyone does it at the same time. But I think, David, these guys are just doing enormous amounts of backdoor bailouts. One of the things at that IMF conference, besides the fact that they do want to transition to the SDR, which would, drastically reduce the dollar's total reserve holdings, is that they want to do an enormous amount of currency swaps. There's going to be an enormous amount of currency swaps that we're not going to find out about, if we ever find out about them, due to maybe a one-time audit if another Ron Paul maybe comes to Congress.
There's a few issues. Certainly, there is transitions ahead. I don't know if it's a 1-year, 3-year, 5-year transition to a new monetary system. This next week, I think you'll enjoy our weekly commentary. We do a lot of discussion on that. So stay tuned for next Wednesday if you're interested in sort of what's next in the world monetary system. Some of the issues with the SDR, which is special drawing rights, represents about 3% of reserve assets on a global basis today, and there's not a lot of trade invoicing that's done in SDRs. So it has a few hurdles in terms of being broadly accepted. And so that isn't to say that it couldn't become very widely accepted in the case of a crisis or some reason for people to doubt the dollar more than they are currently. So that transition could occur, but it hasn't occurred yet. I think your point is well made. We're on the cusp of a major transition. The world monetary system, as we've known it, 71 to present, isn't a workable system. The Chinese don't like it. Number 2 economy in the world. The Europeans don't particularly like it because they'd prefer to be number 1 than anything else. And so figuring out how the euro factors in, how the renminbi factors in, these are countries with national interests, regions with trade interests, and they'll do everything they can to make sure that they're dealt in. Remember that Bretton Woods, the only reason that we were the currency of dominance was because we were the only ones with gold. We were the only ones with gold backing. At the end of World War II, we had 80% of the world's above-ground gold sitting in our bank vaults. And we also had manufacturing ability. We were a massive surplus country, and basically we dictated to the rest of the world, which was utterly bankrupt, exactly what the new monetary system would be. It wasn't actually implemented until 1961, but so that 10-year period from 61 to 71, the Bretton Woods system sort of worked and then broke apart. And we've been sort of living off the fumes of the influence gained through World War I and World War II, the position, if you will, in the marketplace. And now you've got, on a cumulative basis, enough of your emerging markets to say, I don't think this is really in our interest. We need to find a new way. So you could the emerging markets, along with developed countries like China and Russia and many in the Middle East, who would simply say, that was then, this is now, we need to craft something new. I would encourage you to go back and brush off a book, The Structured Scientific Revolutions, where you see that even though there's changes with there's a need for change with an existing system, that change will never occur until those who are in power recognize that it's no longer going to work. So we have problems with the existing monetary system. Everybody knows that. But we don't have a replacement system yet. And until we have a replacement system and the powers that be recognize that the current system is beyond repair, you won't see that sort of revolution in the monetary system. So that could happen 2 weeks from now. It could also happen 10 years from now. It depends on really what happens in terms of current events.
That's a great point, and timing has been very tricky. I mean, I'm friends with Doug Casey, David, and he wrote Crisis Investing in the 1970s, and then he rewrote it again in the 90s. And he was predicting, there's no way the U.S. would be able to keep this thing going that long. And Jim Rogers and other experts like Dr. Mark Faber have been, predicting crashes before this. So it's just amazing that the people in power, these Keynesian central planners, the politicians, have been so good at kicking the can down the road. It's like they just come up with new and more clever schemes and outside-the-box schemes to keep the game going longer than we think it can.
Well, hats off to them. I feel that the long-term implications will ultimately catch up with us, and that's one of the reasons why I do like owning gold and silver. It's no one else's liability, and it's real wealth in my hot little hand, and I get to basically sidestep all of the financial risks that you might have in the securities market. Not that I don't participate in the securities market, but I do like having real wealth in my control as opposed to some counterparty's control. So we'll continue to add to gold and silver on a personal basis and advise it for clients as a means of protecting and preserving and hedging against what we think could be some pretty radical changes. In the last century, we've had 3 or 4 significant changes. We were on the original gold standard, then we had the gold exchange standard, then we had Bretton Woods. Now we're in a brand new monetary era from 71 to present. It wouldn't be any surprise at all to see another major shift in the monetary system. And the question is, as an individual investor, are you prepared to ferry from one system, the old system, to the new, and what's the consequence to your assets as they get repriced in a new currency or by a new currency regime? Are you adequately able to move from the old to the new without taking a major haircut? And in my opinion, gold and silver represent the best way of insuring against a major haircut.
Yeah, and that's good points about gold and silver. I was actually reading your dad's newsletter, the recent one that you recommended, talking about your dad's experience of the 1974-1976 cyclical bear market in gold, where I guess he had gone all in on his gold investments, right? And he had started his gold business. He had bought physical gold with his own money, and he had bought mining stocks. And then, he almost lost everything, but, he stood there with his courage and convictions. He did his market research, and he knew that eventually he was going to be proven right again. Do you think we're going through the same type of thing here with the cyclical bear market similar to 1974 to 1976?
I do, and, whether it lasts another 6 months or whether the worst is already behind us, I think you look at the fundamentals and you say, okay, the fundamentals did in fact quit mattering 2 years ago as funny money and Fed policy, along with ECB, Bank of Japan, and Bank of England policy, have redefined the nature of the markets. The question is, can that last? Can artificial pricing and subterfuge from those banks ultimately define reality? I think it can for a short period of time, but ultimately there is sanity amongst some investors, and I think that will ultimately emerge as very, very important. What are you doing with your money? And do you have some in cash? You should. Do you have some in precious metals? You should. At this point, with current valuations, should you have very much in general equities exposure? But, there's just not much that represents value, compelling value. So there's challenges for the investor today, and I think like the 74 to 76 period, there is, I think, better upside and less downside in the metals position than almost any other asset class out there.
Yeah, I would agree with that. Another commodity I really like is oil, because if the U.S. does lose the petrodollar, and it looks like sometime in the next decade that is also likely, the price of oil in dollars is going to go up. And then there's also supply issues with, despite the shale boom that we've had, that's not cheap oil, and demand is rising faster than supply is globally. So I do like oil in addition, and oil is a lot easier than picking out some of these gold mining stocks, because the oil business, the drillers can be cash flowing a lot faster and generating free cash flow and paying dividends and stuff better than a miner can.
Yeah, certainly resources of any sort. If you're talking about real things, I think this has been for the last 10 years a period where real things have outperformed paper assets. And it wouldn't surprise me to see that continue over the next 2, 3, even 5 or 7 years.
Now, let's talk about physical gold demand globally. You sell a lot of bullion. You sell a lot of numismatic coins too. What are you seeing on the demand side here in the U.S. or to some of your global clients? Is demand for physical gold still strong?
I think where we've seen a waning of interest is in sort of the $2, $3, $5, $10, even $15,000 or $20,000 purchases, and that tends to be a crowd that will follow the price. So, somebody who says, gosh, gold is moving up, I need to own some, and I've got $500 with which to do that. A smaller investor is going to tend to be sort of following the trend, not setting the trend. So they actually have sort of all but disappeared. In the current environment, we are seeing much more interest pick up. Someone who wants to spend $100,000, $500,000, $2 million, where they're saying, we understand, we can read what is happening. We see a tremendous amount of insecurity in the global financial picture, and frankly, we don't think we're getting an honest picture given to us by official statistics. So what do we do at this point with the world overpriced? They're looking at gold and silver as an undervalued asset and moving that direction. So I think the trend makers are already moving that direction, and it wouldn't surprise me to see sort of 2014 to 2015 as a sort of trend resumption period where we turn a corner and start moving up in price again. Again, I think we'll see a lot of the little guys come back into the market once we're back above, say, $1,500, $1,600, $1,700 gold and silver, $25 to $35 an ounce. They'll again say, "Oh, it's moving in price. I want some." So again, it takes a little bit more resolve, and it takes a little bit more conviction in terms of looking at the raw data and saying it does make sense to own gold in a period of time like that. And those are the trends that we see, larger investors beginning to take much more of an interest at these price levels.
Yeah, and when I look at the gold market, I'm a gold analyst and I study a lot of the gold mining stocks and silver mining stocks, and I just look at supply and demand. Let's not even talk about manipulation. I see China, according to the Shanghai Gold Exchange withdrawal numbers from Kuz Jansen, who tracks those, and those are fairly accurate, at least for the private sector in China. They're taking basically 100% of mine supply the last couple years and putting it, off exchange. So demand is very strong. That's not even counting India and the black market, and now India looks like it may reduce the import taxes on that. And then you have the miners who over the last 18 to 24 months, they've been forced to cut all the fat. So the miners just the same business to not go bankrupt, to not shut down a lot of their mines. The grades on gold have dropped the last 10 or 12 years. 12 years ago, I think, the average gold deposit was 10 or 12 grams per ton. And then now it's dropped to, I think, 1 gram per ton or less. And it's just very crazy that you have a market, where rationally eventually something should be going towards reality, which is the supply-demand fundamentals, because if there's a market where demand's very strong and the miners can't really produce anything in a profit, I think most of the miners, including like the really, well-known stalwarts that have been profitable in most markets, those guys have been running at losses now for over a year. And they've had to, trim all the fat, cut their exploration budgets, fire most of their management team, restructure their debt, issue equity. It's just been a disaster, but we should be set up now, I think, like you said, to where, we've been through the pain and now it's time where we're just about ready for the gain.
Yeah, I would agree. I think we are past the worst in that regard. In like the 2008 and 2009 period where most of your Fortune 500 company executives realized they needed to tighten their belts, there were some productivity gains to be garnered in the 2010, 11, and 12 period. And you're right. Finally, the gold managers are taking their job serious and not sort of playing the fence and sitting on the sidelines, allowing the price of gold to do all the work for them.
Yeah, I don't think they have a choice, though, David. It's not like they did it voluntarily. I think like a company, the large company like Barrick, I think the bankers and other people and activist shareholders came in and basically, got rid of a lot of the managers, and their cost of capital is very high, so they had to do a whole bunch of things just to stay in business. I believe they were violating their debt covenants at one point sometime last year, too. So they were almost on the brink at one point because, they were wasting all that money on those large elephant deposits mines. But, I mean, in a period, where commodity prices are low, you can't waste that kind of money on those large mines that are going to take years to develop.
Yeah, we live in interesting times, and I think for the investor who's willing to step back and not necessarily be sucked into bubble vision where, latest, greatest opportunity is the opportunity that everyone's already taken advantage of, I think if someone's willing to sort of buck the trend and look for the undervalued and the less popular, I think your risk-reward profile is actually quite a bit better. So what do the next few years hold? Tremendous opportunity for people who are thinking for themselves.
Exactly. I completely agree. And as long as people, are figuring out ways to add more income and continuing to save in physical gold and silver and not in fiat currencies, I think they're going to end up good, and they're going to have a chance maybe to go in and buy some of these overvalued asset classes after they collapse, or maybe the Dow to gold or Dow to median home income ratios improve drastically when they're priced in gold. But I have one more question here for you. This is about the inflation and deflation debate. Do we have inflation, deflation, or both, depending upon what's being looked at right now? Because I know we keep hearing, Peter Schiff, hyperinflation imminent, or John Williams of Shadow Stats, hyperinflation imminent, and then I hear Harry Dent keep doubling down. It seems like every year, gold's going to 200, but I don't know any mining companies that have any gold deposits left where they can produce any gold at 200. So what's your opinion on this?
Jason, I think it's always easier to make a case that is sort of black and white. And unfortunately, any of us who've not only been around the street as an investor, but also just lived life a little bit, know that there is a little bit of gray, and things are not always so clear. It does take a little bit of nuance. And so do we see inflation? Certainly we see inflation all around us. And the St. Louis Fed just this last week published a report saying, listen, we fully acknowledge one of the best measures of inflation does include food, and that's not in the CPI, that's not in the CP or the CPE, and so or the PCE rather, and but we still need to factor it in. We see inflation in a lot of areas, and if you're counting inflation using the older methodologies, those used by Volcker and others in the 80s and 90s, you have somewhere between 6 and 8% inflation. If you're using the Billion Prices Project from MIT, maybe you're between 4 and 6% inflation, but it's at least double, if not triple or quadruple, the official number. Now that's not hyperinflation. It's just annoying. It's annoying because it's almost like a Cyprus I gotcha by 10%, but we're doing it every year on an involuntary basis. Everyone's worried about sort of a bail-in scenario where banks turn you into a stock owner instead of a depositor. And we have the equivalent of that every year. If you take Volcker's numbers, it's 8%. You're donating 8% extra via the inflation tax every year. I don't know. Where do we ultimately see first inflation, then deflation? You certainly see a large stock of debt and a bunch of bad bets that will have to be unwound at some point. But do appreciate that the entire financial system, the Fed and its credibility, everyone on Wall Street and in Washington, you're talking about basically the world as we know it. They have a vested interest in making sure this game continues on and on and on and on. So even though you could say the world, the mountain of debt is almost like an inverted pyramid, completely unstable and ready to crack apart at any time, you have to look and say also the vested interests. Everyone in politics and in Wall Street want to keep that thing not only together but growing. To me it spells certain asset classes imploding selectively, where you have a deflationary collapse, a liquidation, if you will, of a particular asset class. We saw that in the mortgage-backed securities market already. I think we'll continue to see it in selective debt sectors where you see an implosion. But having said that, you also have the mechanisms in place where inflation, superinflation, or hyperinflation are potential outcomes. To me, the best balance of an asset class, if you're looking at sort of a basic asset allocation, is having a third in cash, a third in gold, and a third in stocks. If you look at your liquid assets on that basis, you've basically said inflation, deflation, or return to a growing business cycle, I could care less. And the one thing I do know is that I don't know what's next. And I think that's one of the things that bothers me about the guys who are hyper-deflationists or hyper-inflationists is they assume that they know more than they actually do, and that is outcomes that include a crowd psychology as a factor which is utterly unpredictable. So to me, it's better to, as an investor, take on a degree of humility and say, don't know what's going to happen next, but I do know I'll do well having spread my bets around. I've got some liquidity in the form of cash and short-term cash equivalent instruments. I've got also liquidity in the form of what I would consider real money, gold and silver, and I also have a stake in the future. If we're wrong and they continue to pull rabbits out of the hat, we have a third of our assets in whether it is fixed income or equities in the paper side. And you can afford to be wrong. If you see an implosion in the stock market, I can almost guarantee you're going to love having a third still in cash with plenty of buying power. If you look at it, best case, worst case scenario, what we call our perspective triangle, that balancing between, again, sort of an equilateral triangle, a third in cash, a third in physical metals, a third in stocks and bonds. It's an idiot-proof way to invest, and I think, frankly, if we looked ourselves more honestly in the mirror, we'd find that we get it more wrong than right, and this is a way to continue to get it right almost every time, though not right 100% of the time. You don't have to be.
Yeah, I think it's dangerous to try to guess perfectly what the central banks are doing because we don't know if they're going to try to, if we do have deflation, another 2008 type event where they try in 1933 again, and then anyone in the United States who holds physical gold here in the United States, there's a 90% windfall profits tax on it or something like that, or which would be a type of confiscation scheme or something like that. But I think all the central banks can do, David, at this stage, all the Keynesian central banks, is, you have the two fat tails, you have the bimodal events, so you have hyperinflation on one side and pure free market forces, deflation, what the Keynesians would call deflation. I just call it the pure free market forces on the other side, and that's basically, a gauge, and then you have a pendulum in between. And what I tell my listeners when I do my podcast is everything else in between is just a different degree of stagflation. So when you're next to the deflation, you have low levels of stagflation because the Keynesians are still putting money or credit into the system and misallocating it, or it's a higher level of stagflation, or it's 1970s bad stagflation close to hyperinflation. So I think that's all that the Keynesian central planners can do at this stage, is just try to move the pendulum back towards the middle of either of the two fat tails while they transition to the next system.
Couldn't agree more.
Now, for the rest of our interview here, I've one more question. You talked about the asset classes being overvalued. You talked about commodities too. Do you think China is going to completely collapse, or do you think they're going to start bailing out banks and municipalities?
They certainly have a lot of capital with which to take on the liabilities of those banks. The banking sector is unhealthy. The loans have been unhealthy. You don't really have a free market in that banking sector anyways. Loans are given to friends, not on the basis of merit. And so, you already have sort of this strange incestuous relationship between business and banking and government, those who are connected to government, the Politburo. To see a further extension of the Politburo and government influence in the banking sector, sure. I mean, that's to assume that banks will implode like they would as if they were operating in a capitalist system. I think it's to neglect the fact that they remain in basically a command economy. There are some capitalistic characteristics there, but in large part it is still a directed economy. So we're all waiting for the next shoe to drop as if market forces mattered, and they do in terms of window dressing, but they don't in terms of the government stepping in and continuing to just window dress. So that's likely what you'll see is more of the emergence. You remember when Japan basically covered over all of the bad loans and nationalized the banking sector in order not to embarrass anyone and make anyone sort of pay the piper. And it led to a good 15, 20 years of stagnant growth and deflation. You could very well have that as a consequence of just covering over and kicking the can down the road in terms of bad loans in China.
Yeah, I think that's a good point, and I think the Chinese people, the people that are in power, maybe the cronies there who are connected to the government money trough or the Communist Party leaders, they've started hedging their bets, and they've come to the United States, they've come to Canada, they've went to Europe and London and Hong Kong with briefcases sometimes of cash to buy real estate, to hedge their bets and move a few family members outside of mainland China just in case once the slow growth does happen, that people debate a revolt or something like that. So it's very interesting what's going on. I mean, I think you mentioned the U.S.'s inflation here, and yes, we do have. It's debatable exactly how much inflation. The U.S. clearly has inflation in consumer prices and food and energy and healthcare and insurance and things like this. But I think the developing world has voluntarily taken a lot of the U.S.'s inflation through dollar pegs and other policy measures through mercantilism to try to prop up the U.S. consumer. But I don't think any of the things we mentioned, David, throughout this entire interview are sustainable, but the timing is going to be very tricky.
Well, and that's one of the reasons why you can't really have an all-in bet on a particular asset class. The timing is very tricky. To move into precious metals with confidence, I think you can on the basis of fundamentals. It doesn't mean you're going to be immediately rewarded. And I think you just need to grow up. As an investor, if you can't wait some period of time for a thesis to work out, then you don't belong in that class of investors. you should go ahead and spend all your money as the Keynesians prescribe, because honestly, it does take some virtues to actually do well over a long period of time. I think the best investors in the world are folks who've taken the longest time frames and think like institutions or foundations, where time is not that's not what's adding pressure to the investment variables or investment thesis. Take time out of the equation. Where do you want to be and on what basis? And allow the long periods of time to take those into a fruitful place. I see people making mistakes all the time saying, listen, the stock market's been great the last 2 years. That's why I am moving completely out of cash and into the stock market, because I need another 30% a year in order to retire next year. And I think I'm going to get that from the stock market. And to me, it's absolutely insane. On the other hand,
it's linear thinking, right? It's unfortunately it's normalcy bias and linear thinking, right?
Exactly. So if you can take time out of the equation and again apply some not only patience but with perspective, say, I'd love to own real things. Yes, I want to own real things, whether that's oil or gold or natural gas, silver, what have you. Great. You don't need 100% of your assets there to do very, very well at some point. To have some in the stock market, that's the one area where I kind of have to wince, because at this point I'd rather have, if I'm going to have a long exposure, you should probably have a decent hedge against that. Taking 10% of your equity position and buying puts on your long-term positions, you should do that. You should hedge your equity position. What's the upside? Well, on a blow-off phase, 18,000, 19,000 on the Dow. Is it justifiable by the numbers? No, it's really not. It's really not. We're already past the point of being justifiable. By many measures, 70 to 80% overvalued. So, to me, I'm most comfortable today with cash and gold. You don't have any income in cash. You don't have any income from gold, which again, for someone living on a fixed income could be very awkward. But if you took those outside pressures out of the equation and said just pragmatically, what should you own today? Some combination between cash and gold.
Very good. And I definitely think those are important cornerstones for anyone's portfolio. I've actually, in addition to my precious metal holdings, which I have very large, I've actually been working on, raising cash. And I haven't spent a lot of my oil dividend stock money, which I had coming in. I've just been building up a nice cash position in my portfolio, waiting for an opportunity. If it's, one of those 3D printing stocks that drops 60%, which in 10 years, I think 3D printing will be quite amazing, but the valuations on those are a little high. But cash is good dry powder, and yes, maybe in a year or two it'll be inflated a little bit and devalued. But if you have the chance to buy an asset class that has a lot of growth in front of it at like a huge discount, then it's worth it.
How long would you wait for that kind of an opportunity? I mean, if you had to wait for 5 years to buy something at 20 cents on the dollar, and is that unreasonable to you? Where risk has been wrung out, and just to return to fair value, not even premiums. This is I think what most people forget. You make money on the basis of what you pay for something, and so being patient and waiting for value. I don't think most people understand that. And if they would stop chasing trends, sit back, relax, quit treating this like it's a 20 or 50 or 100-yard dash, and realize that as an investor, this is a marathon. You have to pace yourself. You have to be calculated and know that finishing, frankly, is adequate. It's adequate. You don't have to finish first. You don't have to be the next hedge fund manager that makes $5 billion in a year. You'll do very well if you approach the markets from a dispassionate perspective and take some of the emotion out of the equation. Wait for it. Most people don't have that. And if you don't, hey, God bless you. Go do something else with your money.
Or they should give it to you, David, because you're gonna save them from themselves. Because that's why most people should not manage their money. Most people, buy high and sell low. They do the exact wrong thing at the exact wrong time.
The people who are most compatible with us as clients are folks that do have more of a philosophical perspective that's compatible with ours. We're not going to do well with someone who's expecting us to sort of day trade their account, because honestly, the biggest opportunities are not sort of trading for nickels and dimes. And I realize high-frequency trading has sort of tried to define that as the current landscape. But still, you look at the capital markets and the history of the capital markets, and whatever the newest innovative trend has been, it's come and it's gone. And there still is this essence of value investing where, again, it doesn't have to be balance sheet value investing. There's certainly long-term trends and macro trends which can influence the success of a value investor. I think you're in a position, if you approach the markets this way, you should do very well over the next 3, 4, 5 years. Try to change your time frame. If you think you're looking for sort of what the results are 2014 or by the end of this next quarter, I think you're missing where opportunities do develop. I mean, again, maybe 3D printing isn't at the top of my list today. Maybe it's not at the top of your list today. But at the right price, when do you evaluate and say, it's compelling because of what it is and what it shall be, and I can wait another 3 to 5 years. If I wait 3 years to make the purchase, I can certainly wait 3 years to see it materialize in terms of gains. And I think what you see with that kind of a mindset is multiples of growth. Forget looking for a 10% return per year, a 20% return per year. If you can recalibrate your time frames, now you're talking about multiples in terms of growth on cost basis.
Exactly, and but most people, unfortunately, David, don't think long term like that. Most investors see long term now as a year or less now. And I think that's like our myopia in our society and our culture, and just the TV programs on mainstream media. It's just fed into that myopia, and the rent-seeking politicians and the people on Wall Street that they've fed into the myopia, unfortunately.
Well, Jason, great to be with you again. Look forward to joining on your program again sometime soon.
Yeah, exactly. And David, can you please tell our listeners more about your McAlvany Weekly Commentary and your other companies where they can buy bullion or get their money managed by you?
Yeah, McAlvany.com is our primary website, and you can sort of go wherever you want from there to our commentary website, to our wealth management website, to our precious metals website. We've been in the precious metals business for over 42, almost 43 years, one of the largest in the business, and focuses on bullion and near bullion products. Rarities aren't really our area of expertise or area of interest. Money management, I mean, as we've described, you can certainly get to know us through the weekly commentary and our Friday comments, which is sort of a market wrap-up. That's something I think worth exploring if you're a longer-term investor and aren't of the mind to manage yourself on a day-to-day basis. The weekly commentary is just our expression of continued education. We want to see our clients own the decisions they're making, and although they may defer some of those to us, we want them to do that from the most informed perspective possible. So it really is a little bit like being a fly on the wall. If you listen to the weekly commentary, these are the thoughts that we express in the office. These are the ideas that we explore on a daily, weekly, monthly basis. And we feel that if there's a time that or an area where we can't get to the answer, we'll explore with anyone, anywhere in the world, getting that answer from the experts. So it's a good intellectual exercise, and I think a great way to get to know kind of what's important to us and why.
Yeah, and I strongly refer my listeners to definitely, if you have time, go listen to the McAlvany Weekly Commentary. It's once a week, comes out I think on Wednesdays. It's free, and it's normally a great 30 or 40 minutes. I listen to it every single week for many years now. I don't think I've missed one. So thanks for.
I'll just mention one last thing. It's not often that I get to brag about my dad. I should perhaps more. He started the business 42 years ago, and he's been writing his newsletter, the McAlvany Intelligence Advisor, for 38 years, every month for 38 years. And a lot of wisdom goes into that. As you mentioned, he highlights some of the challenges of the 1974 to 76 cyclical bear market in gold. And I think for anyone interested, not only in the metals market, but a longer-term perspective on investing, frankly, if you want to get to know us and sort of who has set the tone for this kind of an office, it is my father. And I can't think of a better letter than the July McAlvany Intelligence Advisor to get to know us. We'll send you a free copy if you request that. You can either go to McAlvany.com and request it, or call our 800 number and just mention that you heard about it on Jason's show, 800-525 9556 is our toll-free number, 800-525-9556. A free letter request the July MIA. You won't be disappointed. I think it's one of the best he's ever written.
Yeah, it was very good. Now, David, I just want to thank you again for your time, and keep up the great work with your McAlvany Weekly Commentary. It's one of the favorite things, and it's taught me a lot since I started learning about investing in the stock market in 2007 and 2008.
Thanks, Jason. I'd love seeing your progress.